Hello, everyone, and welcome to this webinar. As we like to say here in Oxford, good morning, good afternoon, and good evening, because we don't know where you're joining us from. So during this webinar, we also would like to hear where you're joining from, and please drop it into the chat. My name is Clara Blackings, and I'm a program consultant here at Side Business School. And this webinar is in support of the Oxford Real Estate Programme here at the University of Oxford. Today, we'll be talking about real estate at a crossroads, navigating risk, regulation, and return. And we will be joined by two of our academics here at the business school. Whilst we're waiting for people to come through, I just want to go through a little bit of housekeeping. So this webinar will be recorded. So if you haven't had the opportunity to watch, you will be sent this in the email in which you registered. During the webinar, you'll have plenty of opportunity to put your questions in the Q&A box. Our team will be in the background answering questions, and the academic directors will be trying to answer as many questions as possible during the broadcast. But if there's a burning question that you have, or there's a topic that gathers your interest, please feel free to put it in the chat and we'll try our best to get to them. So as we begin, I'd like to take the opportunity to introduce you to Martin Schmalz, who is the Academic Director of the Oxford Real Estate Programme, and wish you all a wonderful webinar.
Yeah, thank you very much, Clara, and thanks everyone for joining. Thanks for your time and your interest. I'm excited for the next hour. I'm here with Andrew Baum, who is an emeritus professor at the Side Business School and one of the most influential voices really in real estate and investment and prop tech in particular worldwide, and my predecessor in this role. So whereas I am these days the director of the Future of Real Estate Initiative, Andy founded and led the Future of Real Estate Initiative for many years and has really lifted up worldwide in with the PropTech 3.0 report and other cutting edge topics in real estate. He is not only an academic, but also has deep industry experience at Prudential, CBRE, Grosvenor, Newcore Capital, and multiple other roles. So I have big footsteps here to fill. And I'm excited to have him here and learn from him today. So welcome, Andy.
Martin, thank you very much. I have to say that was a very nice introduction, and I just had to say that I'm delighted that you're following me, Martin, and I think you're going to do a great job. So hopefully you've got the old in the form of me and the new in the form of Martin, and I hope that between us we'll be able to produce something interesting that's going to be reflected upon in the July Oxford Real Estate Programme, which we're both teaching in, where Martin's the academic director and I'm the programme director. So hopefully some of you will get to see us in Oxford in July.
Yeah, that indeed would be quite exciting to have you meet in person, have fancy college dinners and all these good things in addition to the academic content. So we wanted to, so this webinar is titled Real Estate at a Crossroads. And so we wanted to really take a look into the past few years and into the next few years and think about what has changed. So I wanted to start by asking Andy, what in the Future of Real Estate Initiative, at the time when you founded this, what was ahead in terms of technology in real estate? You wrote articles about it. What did you get right? What did you miss? What has changed since then?
Well, I missed a lot of things, and I'm not sure. I mean, most of the reports we write will have fairly guarded conclusions because it's very difficult to research the future, of course. And my speculations are probably worth no more than anybody's speculations. But the situation we found ourselves in about 2015 was that I'd been teaching real estate for a long time, 30 odd years, and the real estate market, as a lot of you will know, is hooked on this concept of the cycle, where things repeat themselves. So we end up with overbuilding and rents falling, and then we end up with a shortage of buildings and rents rise. Capital values go up, they go down. Real estate people love to think that there's a time to invest, which is the bottom of the cycle, and a time to sell, which is the top of the cycle. And around 2015, we'd had a pretty big crash in 2007, you know, arguably the biggest that I've seen in my lifetime. And it felt as if something was changing. It wasn't all to do with cycles. We didn't see that the market was just going to recover and go to another high in the mid to late 20s or teens. There was something else going on. And what was going on was clearly a technology driven change in the way we saw real estate. And it wasn't just technology, it was also sustainability regulations. So that the fundamental nature of the asset class changed at some point. And the big sign of this was the early 2000s when retail property started to get disrupted by online selling, online trading, and Amazon and so on. So that what had been the most popular asset class became the least popular asset class. And that wasn't cyclical. That was a fundamental paradigm shift. And so by 2015, we've got this question really, which is how many of these things that are going on in the market are paradigm shifts and how many of them are cyclical? And clearly, there was a hypothesis that technology produces a paradigm shift, and
Mhm.
sustainability regulations could be doing the same thing. And so, let's break out of this idea of teaching real estate as an investment, which has got the same fundamentals going forward, and start to think about what the future will hold for real estate professionals, for MBA students, for executives generally. And so that was the trigger for the work program that we put in place in about 2017.
Well, that's very exciting. And so you mentioned a few things that I want to pick up on. So one being that researching the past is kind of tough. So, and I think that is truly something that distinguishes the Oxford Real Estate Program and the Future of Real Estate Initiative. It's in the name. That we are, well, bold enough or foolish enough, I guess, to try and think about the future. And so that involves theorizing, not, I don't by that mean by that hallucinating like the generative AI does. I mean theorizing based on solid economics, as opposed to analyzing what happened 30 years ago in the data, which is, only so useful for practitioners. So I think that's indeed something how Oxford and the Oxford program distinguishes itself from what is being done elsewhere in the world. But also I wanted to pick up on the various waves you mentioned, right? So there was the securitization wave that happened before the 2007-8, well, real estate slash financial crisis. There are REITs, which in Europe haven't quite picked up as much as in the US, I would say. Then there's a prop tech and ESG wave, and the European Commission has rowed back quite a bit on the ESG requirements, but still, it's still a thing that undeniably. So I guess the real question in the room today at the crossroads is whether AI, the new iteration of AI, not traditional machine learning as until ChatGPT, but generative AI, if that is just one of these additional waves and incremental technological steps forward, or whether that's really a fundamental change that is going to change how real estate markets function looking into the future. So where do you stand on that?
Well, I do think it's a fundamental change, but it's not the first fundamental change that I've seen that's been driven by technology. So I see this as about the fourth tech wave that I will live through. I remember going to teach in Singapore in 1982, and on a Saturday morning, I would do a class on how to use the IBM PC XT with twin floppy disk drives and how to
Mhm.
use VisiCalc, or it may have been SuperCalc, as the first sort of spreadsheet. And at the time, I was pretty sure. I knew I had to give up my Saturday mornings because this wasn't a question. This wasn't a debatable issue. This was gonna change everything. And so it did change a lot of things. It changed the way we work. And of course, people at the time were waving red flags about we won't need as many offices because computers are going to take over. And here we go again, of
Uh-huh.
course.
Uh-huh.
So that was the first shift, and that had knock-on effects about the way the property market works. We introduced benchmarking, performance measurement. It became a much more professional industry, a more efficient industry, thanks to the fact that we could compute numbers more quickly. And then I also remember being working at Henderson, which is now Nuveen, in 2000, sorry, 1995, when my co-founder, John Partridge, who was a technophile, said there's something happening. We're gonna start changing all the software we use because email is going to be a big thing, and internet is going to start taking over everything we do. So we invested heavily in training. Again, we knew this was a significant change. We knew there was no going back. So we all learned email. We all got familiar with the internet and how that worked. That had a knock-on effect in the property market again. We had internet-based businesses for the first time. We actually had a dot-com boom in the late 90s. Then we had a dot-com crash. I got caught right in the middle of it because we created something called Freeman's Guide to the Property Industry, which was a massive encyclopedia of data about the property market, which was originally published as a book, would you believe, in 1999, just as technology was being made available to create websites. Although the websites were presaged by CD-ROMs, if you remember that. So our business became CD-ROM type business. So that was a big change because data was now available in much bigger quantities and be supplied to people. And then 2008, the third big wave, which I pretty much missed because I was too old by then, but the App Store was launched by Apple, and the iPhone 4 came out with the App Store preloaded. And young people, I think, had become a little bit disillusioned with the financial system because the 2008 crash had sort of damaged people's faith in bankers, for example. So the ability to directly look at rooms through an internet site led to things like Airbnb. And this is sort of the classic disintermediation of the broking community, the advisory community, where you've now got human beings finding rooms directly through their app. And I think that had big knock-on effects that were still working their way through in 2015 when we started thinking about the future of real estate initiative. So I think we've got a deep technologically driven change going on in the property market by 2015, 2016. And that was to do with disintermediation and direct access to rooms by people. So coming up to now, the fourth wave that I think is going on is the AI wave. I think it's going to
Mhm.
be as impactful as the first three. It may not be significantly more disruptive than the first three, but it's clearly a big thing that's going on. And again, I find myself on a Saturday morning sitting in a classroom trying to learn about it. So again, there's no doubt this is a big thing. And we can talk about how big a thing it's going to be, Martin. You know as much about it as I do.
Well, this is really instructive to me. I don't know about the audience, but when I hear you talk about um, back in the day when computers came in and people talked about the redundancy of office space, that obviously there is a bit of a resonance with current narratives out there in the market, no? So that surely would inform your perspective on how you read the news today. So this is quite exciting. So obviously, so technology is a big thing now, which remains a challenge for us to catch up on. And I have to say, Andy, you make me feel old because now I feel like thinking back to in 2017 when I started a quantitative hedge fund and really got deep into old style machine learning. Came back to business school and decided all our students need to learn Python, which, needless to say, less than 10 years later seems like a complete waste of time, given that that's what computers do for you these days, right? I'm feeling old, given that I seem to have gone through more than one wave at this point as well. And I guess like my perfectly subjective feeling here is that the speed of change has just accelerated dramatically with this current wave, without prejudging whether it's going to be a bigger one or not and what the implications will be. But anyway, so with these reflections, I just wanted to hear from you what you view aside from the technological changes, the main challenges for real estate investors and managers right now. Is it the sustainability mandates? Is it other types of regulation? Is it the interest rate environment? What is it that you see as the main challenges at this point?
Well, I think the main challenge is relevance, and I'll come back to that in a minute. I think the question that we all have to reflect on, going back to what I started saying at the beginning about this difference between cyclical changes in markets and structural changes or new paradigms, is it affects real estate deeply this time because the one thing Mark Twain said, buy real estate or buy land, they're not making it anymore. But of course, theoretically now we are making it. We are creating infinite acres of of cyberspace and the metaverse. So, there is now an infinite amount of space in which we can trade, we can buy things, we can work. And so the old sort of dominance of real estate landlords has been somewhat damaged by this tech change. It's just, and I think it's deep seated this, so we used to have very long leases in the UK, 25-year leases with up and only rent reviews, where landlords were powerful. They effectively dictated the terms. It was a sort of an oligopoly of big companies owning the property in London. Now that's changed somewhat, and leases are shorter because tenants have more power. Tenants can now demand the sort of building they want to occupy.
Right.
And it's gone even deeper now since COVID because now the workers who are valuable, high quality talent is valuable, and the talent can decide whether it wants to come to the office to work or not to some extent. And so employers are now also sort of being slightly disempowered by their own workers. So we've got this shift from the landlord and the tenant to the investor and the customer. And the
Right.
customer now needs to be looked after. And that's a fundamental difference. It's a real change that's gone on in the last 20 years. And of course, it means that we have to understand all of the business school disciplines that other industries have been familiar with for decades. So we're no longer this special market. And it's given significant challenges to traditional real estate investors and, in my perspective, real estate investment managers, the professionals, because people like me who have been real estate managers for half of their career, 25 years worth, we grow up understanding how to be a landlord in a
Mm.
landlord friendly market where we would have a long lease in retail property or office property or industrial property, and we had lots of disempowered tenants, and that was the skill that we learned, and it was pretty landlord friendly. But now the popular sectors in the property market are no longer retail and office, particularly. The next gen real estate classes tend to be much more complicated. So it's residential property, having people in your building overnight is complicated. It's healthcare property, it's student housing, it's hotels, things that were always seen as risky, and risky for a good reason, because you've got people in these buildings overnight and things can go wrong. So that, for example, if you invest in care homes as a property investor and your operator goes bust, you are suddenly responsible for a lot of old people, some of whom are not very well, in your building overnight. What are you going to do? You become the CEO overnight of a retirement home. So this is very challenging for real estate people. And at the same time, another area of the market which is booming, of course, data centers is the classic example. Data centers and other types of property that are fundamental to the future of society, very, very important indeed. Healthcare, data centers, educational property, waste disposal, energy generation. These sectors, which are exciting and new and booming, are being attacked by infrastructure managers. So the real estate
Mm.
manager of the past is now in a bit of a difficult situation because he's got a shrinking traditional market, he's got an operationally complex new market that he could attack, but he's also got this infrastructure sector which other people are taking a big bite out of. So I think they're the main challenges. When you overlay sustainability on top of this, and
Mm.
regulations which have made a lot of real estate assets non-viable,
Mm.
then I think we've got a bit of a bind. And so when we talk about real estate at the turning point, I genuinely think we are. I really think we are at a turning point position, particularly in the European markets right now.
Yeah, I guess you're pointing to a topic that we were going to address uh, that relates to viability of new developments in Europe, as well as what people call the housing affordability challenge. Um, so, do you want to expand a bit on that?
Yeah, I do. If we take the UK housing market as a sort of a reasonably simple example, there are many, many developers I've spoken to in the last year who say they simply cannot make their schemes add up. So you've got four variables really going on. You've got the completed value of the development once you've built it. So what is your housing development worth at the end of the day? You've got the land that you have to buy, let's say, in the most simple example. You've got the profit that you need to make to keep yourself in business. And then you've got the construction costs, which are, of course, necessary to complete the development.
and
And
which have
what,
really exploded during the
well,
COVID period. Yeah.
absolutely. And we can characterize the real estate market, the most conservative types of landlords that you can think of. If you go all the way back to the feudal ages, the Middle Ages, the landlord is a landowner, and the landowner exploits the weaker members of society, and he's
Mm.
never in a position where he has to sell his land because he's
Hmm.
wealthy. And it's not miles away from where we are. There are still privileged people who own land and don't feel that they have to sell it. They're not under pressure necessarily to sell it at market prices, and so they can hoard it. They can keep it from the market. So we have a situation where building costs have skyrocketed. That happened because of the Ukraine war, and now it's happening again thanks to the Middle East war. So we've got a boom in building costs. We've got land prices which are inflexible on the downside. They're sticky, so they don't respond very quickly. People have to make a profit to stay in business. And so the only bit of the equation that could change to save us is if prices rose a lot. But we have an affordability problem. So people no longer can afford to buy houses at the prices which we need to get for them in order to build them. So the result, of course, is despite the Labour Party saying that their big target is going to be to free up the planning system and build a lot of homes, what's happened? They're building fewer homes, or we're building fewer homes than we were before the Labour Party came into power. So we have an absolute viability crisis in the UK that's going to lead to a housing problem. And I suspect there are other countries like the UK. You can tell me, Martin, but I think that's the sort of the viability crunch that we're in right now.
Yeah, so let me pick up on a few points here and plug some shameless Oxford research here that has been done on these topics. So, for one thing, is you mentioned casually that land prices are sticky on the downside. So, me being an academic researcher, of course, I take these stories and say, do we really know that this is true, or is that just a story that practitioners tell, right? And so we have some recent research on that question, which I think for the first time in the world really has clean evidence that shows that land prices really are sticky to the downside. So asset prices are sticky. Now that has huge implications for how you do monetary policy and how you understand the positive correlation between transaction volumes and prices, right? So when prices go up, you tend to get more returns. When prices go down, they can go down. The question is just, is there just a correlation? Because lots of things correlate in the time series, or is there really a cause link between them? And we've done some research on Norwegian residential real estate, where some parts of the country delineated with a super sharp line, like one side of the street versus the other. Some houses suddenly were charged 10 times as high electricity prices than the others. And that's, by the way, because of electricity cables being laid between the UK and Norway, among others, right? So suddenly Norwegian electricity prices go up by 10% in some regions, but not others, which of course knocks out value out of the residential real estate, no? Because say, if instead of paying a 500 pound electricity bill, you suddenly pay 1,000. That's 500 more a month times 10 is about 6,000 more a year. Now, everybody who knows how to capitalize cash flows into the future, that's easily, say, 100,000 quid over a lifetime. So if you suddenly, from one day to the next, knock out 100,000 quid out of your real estate price, it would seem to start to matter, no? So just ballpark wise. And the relevance of that, of course, is also now connected to the data centers, right? If you're lucky enough and to have a data center plugged in your neighborhood, that data center consumes a lot of electricity, which drives up the electricity prices. That increases your electricity bill, right? So that transfers wealth from you as the property owner or of your landlord, but he's going to increase the rents if he can, to essentially the data center provider, no, through the price mechanism. And that is a thorny regulatory issue that we're trying to inform policymakers about. So if that is something that affects you on one side or the other of the trade-off, you should really get in touch and talk to us because we're really in the hot phases of pushing out that research, hosting roundtables, and so forth, and making regulators informed about the issue. Andrew, you seem like you want to chip in there.
Yeah, yeah. Well, I would say this is what makes you such an interesting guy, Martin. Because you are you come from an entrepreneurial family that's owned real estate. You You are a professor of finance, so you understand the broader financial markets and financial academic financial research, finance research. You've got this interest in real estate, and you've been a regulator in the US. And so you have this great sort of breadth of interests that are all relevant to the real estate market. And I'm wondering whether you think that the European markets in particular have got a problem that they're going to struggle to get back out of. If we take my viability example,
Yeah.
the fact that building costs have gone up, and it's been that problem has been exacerbated. The more regulations you have about improving standards of housing, in London, for example, putting two fire escape staircases in every block of flats for the first time, or sustainability regulations without grants. Those things are loading up the burden on the cost side without any return coming back. So given your regulatory experience, do you think the European markets are over-regulated, or do you think we just have to find a different way out of this?
Yeah, so this is a great question. And so the regulatory experience Andrew refers to is that I spent 2 years while on leave from Oxford, who kindly let me go. I played chief economist of the regulator of the audit firms. So those guys that are supposed to check the annual reports of all publicly traded companies on the planet effectively. So the rules that govern more than $70 trillion of equity market cap, and then the credit that comes on top of that. So those rules is what the Public Company Accounting Oversight Board writes and enforces. And I was the chief economist there and ran the division, so the Office of Economic and Risk Analysis, sampling the audits we would inspect and so forth. Now, in that role, of course, I did think a lot about whether there's too much regulation, which you can imagine in the American political spectrum, you will hear from one side, and from the other side, you'll hear, but look what's happening out there in the world. No? And what I come out with from this experience is that really the issue shouldn't be about too much versus too little regulation, but about good versus bad regulation. So let me make the case for regulation. So first, I'll acknowledge my academic bias. If you go to grad school in economics and you learn economics 501, you start with welfare theorems that free markets allocate resources in the best possible way, roughly speaking, unless there's a market failure. And if there is such a market failure, a benevolent dictator can come in. And you think of that as a government who can fix that market failure by intervening in that market in one way or the other, right? Now, but there's also then an Eco 502 version of that, which says, turns out governments are not necessarily benevolent dictators because regulators have their own funky incentives and all kinds of reasons why they might not come to the optimal policy, be that misaligned incentives on their own or a lack of knowledge, a lack of understanding of what the equilibrium effects of such regulations would be, and so forth. So I definitely walked into this experience with a very different attitude than I walked out of it. So to say this politely, Now, getting to real estate, you mentioned the timescales, no? And I'll take this back to fundamental finance, MBA, financial management 101 type of stuff. And the first thing you learn is about time values of money. Look, if your project suddenly takes us 7 years instead of 5 years because of some environmental impact assessment study or something that you have to do, and you have to provide for that capital for 2 years longer before the returns start coming in, yes, that will make projects unviable that otherwise would have been unviable. This is not a statement of me being against environmental regulation. That is not me saying the world is over-regulated. This is just how finance works and how the time value of money works. So there's nothing to debate about how clearly delays in the planning process, whether due to environmental regulations or any other regulation, would make some projects less viable than others. Now, you mentioned, it's two staircases. I mean, when I look at the history of cities, it turns out they tended to burn down a bunch. And I and I will just claim without evidence that the reason they don't burn down anymore is because we have some pretty good regulation in terms of making buildings fireproof and so forth. So again, I don't want anybody to take away from this and said Martin says the market is over-regulated or we gotta get rid of all the regulation or whatnot, because I'm definitely not saying that. There are some really good regulations. There are some probably less necessary ones, and then there's a gray zone in between, no? And obviously the difficult part is to tease out exactly what those gray zones are. Now, but I will emphasize that there is definitely a cost to these regulations that result in less projects being realized, less housing stock being built. So taking this just on the residential side, I'll plug the second piece of Oxford research, which is not research by myself or Andy, but like 20 years ago, Oxford academics wrote studies for the UK government explaining that we need to build 800,000 new homes in the country to avoid an affordability crisis. Uh, Guess what? We didn't build 800,000 houses. We built like 8,000 or so, and we have an affordability crisis. So it is not a matter of not understanding that this is the issue. It's a matter of the polite way of calling that is political economy. No, people acting according to their incentives. And in the UK, what do we have? A home ownership of rate of what? 66%, something like that, or 66% of the electorate owns houses. So you're basically running a campaign and saying, hey, look what? I'm going to build a whole bunch of new houses that increase the supply. It drives down the price of your most important asset in your portfolio. How do you like that idea? No? So people like to talk a lot about affordability, but also we just got to recognize that there is a huge constituent of the population, the voting population, that would not like it very much if we made housing affordable again, which is another way of saying like, hey, we depress real estate prices. That's going to hurt the population, is going to hurt the banks, and so forth. And in the aforementioned financial crisis, I mean, the whole policy intervention was designed to prop up asset prices. It just turns out that this is not how you run a capitalist economy. You end up with all kinds of follow-on problems if you try to effectively regulate or cap prices. Same thing for rents, right? So in New York City, someone just won an election based on the promise of regulating rents. But of course, it's going to deter more investment in additional residential real estate. There's just no arguing about that. And
Yeah, yeah.
and I don't know whether people don't understand these basic points of economics, or if there are other reasons for them to
It's a
just
continuing
acting in the interest of
frustration,
their
Martin.
constituents by not wanting to understand that. No?
Yeah, I agree. I mean, absolutely, a continuing problem is exactly that issue. It's trying to work out whether governments just haven't put the work into understanding the economics, or whether they are driven by political concerns in the face of their knowledge about these economic issues. I'd love to see a piece of Oxford research which will conclude about how many fewer houses are being built because of bat surveys.
Aha, bad survey.
Right.
Say more about
So,
that.
I personally have spent £4,000 on bat surveys in the last year. I don't really know why. There are probably bat fans out there who will explain to me why, but
Mhm.
that bat survey multiplied by many, 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 many more people will, of course, reduce the number of houses being built. And I'm not sure whether the government gets that really.
Yeah,
So we need
absolutely.
more
Yeah.
research, that's for sure. That's the data. I've got a comment here from Melt from South Africa saying that South Africa's in exactly the same situation. We've got with the same problem about lack of viability in the markets, and he's also made the point that another cost which has risen recently is the cost of funding. Of course,
Yep.
interest costs have gone up as well. So we've got an even bigger bind in all of that stuff. What
And of
what
course, there's the $300 trillion question as to what the path of interest rates is going to be in the future. And
uh,
yeah, that I guess
well
goes a
well
bit beyond what we want to discuss here.
I used to pretend that I could forecast real estate prices, which included forecasting real estate cap rates. And of course, my real estate cap rate model included within it a forecast of interest rates. And then I realized that if I could forecast interest rates, I shouldn't really be a real estate forecaster. I may as so it's an impossible situation to be in. We've got one good idea though, Martin, which I think we need to talk about, which is switching the thinking about real estate. So real estate is currently a power user. It competes for power in a power constrained world, and we've seen that exaggerated in the last couple of weeks. It competes for power, and it also poisons the air. So it's a carbon emitter, it's a power user, that makes it a pretty bad asset on two counts. However, we also know that sustainability regulations are reducing the bad effects of real estate. But what we've not really talked about is the extent to which real estate can generate power.
Uh-huh.
And I know that you're interested in this concept of powered land, and I'm intrigued. I'm really intrigued as to whether this is the solution to the viability problem. So, are we approaching a world where properties will generate power and
Mm.
also, of course, store data? So they'll be their own data centers. How do you think we're going?
I mean, so that is a question that's indeed very dear to my heart. And so you mentioned that I come from a family that really runs a manufacturing firm, but also for 3 decades or so has put up windmills, wind power station developed sites there on a very small scale, really. But still, I've been hooked up to that topic for a long time. So the value of land having something to do with the ability to produce energy rather than consume it is something that I have thought about for a long time. Now, with the increased demand for electricity from data centers, AI, and so forth, that strikes me and many out there in the industry, including our executive in residence, James Lapushner, that you shall get to see if you join the Oxford Real Estate Program. Um, Really strikes me as something that will become absolutely central. So go to a theoretical extreme here. Like, allow me to speculate, and I label it as such because it's a speculation about the future of real estate. The in an age where AI more or less substitutes for a large fraction of the tasks that white collar workers do in their jobs. At that point, companies are going to start equating the marginal cost of electricity with the marginal cost of labor. No? So you're going to buy so many tokens of Claude code or whatever your AI tool is, so as to equate the marginal cost and benefits between employing labor versus agents. So really, then the determinant of productivity in a particular geography is going to be determined by the price of electricity. And once countries realize that, they are going to emphasize investments in these sectors. And there's huge regulatory questions that pop up as a result of it, right? So, for example, should really the local homeowners and the property owners be the ones who bear the consequences of the increased demand for electricity, which I previously mentioned, and I think there are relatively clear theoretical answers to that. In the US, they are slightly ahead of that by just demanding that the data centers provide their own electricity, right? But I think in Europe, there's some regulation to be done there. This is one of many determinants, another one being sustainability regulation, that is going to impact how real estate is being priced, how real estate is going to be valued, um, and um, and how regulation really impacts real estate prices. So that's something that, frankly, 20 years ago we just didn't have to think about very much, because electricity prices were probably not the absolute first order determinant of what you thought about. But nowadays, it is absolutely going to be so. At least if you're somewhat of a techno optimist. And so I think that's necessary to think about. Right. I just closed this point by saying I lived in Arlington, Virginia, when I was a regulator in Washington. This is where the data centers sit, because of the electricity availability, water availability. You're close to where the connectivity is, and you could absolutely see that in the real estate prices and the electricity costs there. And it does lead to political backlash, right? So this is why we emphasize at the Future of Real Estate Initiative three research areas, one being, so three pillars of the research, one being AI and technology, what it does to real estate, the second one being sustainability, and the third one being regulation, whereas all of these three things obviously interact. And so thinking about powered land, as you called it, or digital infrastructure, is something that nobody else in the world is really doing. And we're out there trying to see how much interest there is in industry to also fund and sponsor more research in that direction. And yeah, you'll learn more about this if and when you join the real estate program. So looking forward to discussing more about this.
You made a great point, Martin, about the research project on Norwegian electricity prices, and if you did capitalize the extra energy cost into a current value of 100,000, you do wonder when people will, how quickly people get that, how quickly it goes into people's pricing decisions, because
Mhm.
we have this very path dependent way of thinking about real estate prices, particularly in the housing market, where we look at comparable evidence of previous houses. If we've paid 2 million for our house, we're not going to sell it for less than 2 million, no matter
That's
what's
right.
changed fundamentally. But you do wonder, I mean, at some point, presumably, that 100,000 will get discounted from the value of the house. And equally, at some point, when somebody realizes that they can generate power through windmills, solar, whatever it is, on their property, then they can start reversing that equation and house prices will start increasing when you start generating power.
I mean, so this is quite literally what you see in the data. I previously mentioned this study in Norway that we did, where we can essentially allocate like a pill of higher electricity costs on some houses, but not others. So effectively run a randomized control trial on residential real estate. And I mentioned previously that what you see is that sales volume does go down for real estate, and that seems intuitive. But let's think about this for a second. Like, why is it that house prices wouldn't just immediately collapse far enough so that all the transactions that are supposed to happen actually do happen? And you refer to some psychological mechanisms, I guess one calls it behavioral economics or behavioral finance these days, that would explain that. Namely, you say, I have this nominal anchor, which is the price at which I bought the house, or perhaps I have a loan, a mortgage outstanding, and I'm not going to sell below that price. I mean, frankly, that's not a particularly good reason not to sell your house. I always say the house doesn't know at which price you bought it, neither does the seller. Like that is not supposed to be an important number in neoclassical economics, but in practice it is, no? So it does seem you see it very sharply in the data that precisely that those households that would have to sell at a nominal loss are those that tend to not sell and wait out longer, keep the house on the market for longer, and that's why you see this decline in price volumes. What I have not yet talked about is that you also see that those houses start to invest in the solar roofs and insulation of their houses, so reduce electricity consumption. You put capital in, but then you have less cash outflow in the future, right? Or a positive revenue from having the electricity generations on the roof. And our associate scholar, Chloe Garnache, who comes and teaches in the program as well in the EMBA and MBA programs, comes in from the ETH in Zurich. She's doing some follow-on work using similar data, documenting the investments in electricity production, in particular solar roofs, and the technologies of reducing electricity consumption for exactly those houses that got treated with higher electricity prices. So this is exactly the kind of research that is going on at the Future of Real Estate
That's
initiative.
great, Martin. I could push it a bit harder. I've got an interesting question from Diraj about Dubai, Riyadh, and so on. I mean, very quick answer to Diraj's question, which is about we've seen massive growth in these markets. All I'd say is that what goes up must come down. If you're in a real estate market, which is a real market, then you'll have price rises, and they'll be followed by price falls at some point in the future. So there's never a one-way bet. Um, just going back to the power issue, that what we've been talking about residential properties quite a lot, and the beauty of residential, particularly owner-occupied residential, is that all of the economics are internalized in the decisions of the homeowner. Whereas if you go to the commercial property market, where we've got bigger deals going on in London offices and shopping centres, we've got a more complex situation because the person benefiting from lower power costs, for example, may not be the owner. It may be the occupier of the property, and it may not be completely clear who would own the power that is generated from the property, whether that be the freeholder of the building or whether it be Amazon that occupies the warehouse, who might even be able to prevent the owner from getting into the building to put solar panels on the roof. And we've got this inefficiency. Another thing that we need to work on is this inefficiency of the way in which these contracts are negotiated. And I think a lot of them are being negotiated in ignorance of the whole power
Mhm.
question.
Indeed,
Uh,
yeah.
yeah. So is that
Um,
an issue for us? Is it an issue for the regulator? How do you think we're going to work that
well,
one out?
I think it's an issue for every regulator and it's very local. Also, there's a question by another attendee on how one would balance seeking high returns and managing the increasing regulatory risks. I think those are just super local questions, right? So one of the fun pieces of being in the Oxford real estate program is that we have students from everywhere. So I'm having more fun teaching at Oxford than anywhere else on planet Earth that I've tried, precisely because it brings together all these different perspectives. And housing regulation is notoriously local and works completely differently in different markets. So there's not necessarily a crystal ball type of answer to these kind of general questions, but what you will learn is just by example a sense of the vast variation in what this regulation looks like, and therefore how the answers are completely differently, right? So, for example, in Germany, if you do build a windmill next to your factory, the regulator prohibits you from using electricity yourself. You're forced to sell it to the grid, which is operated by a de facto energy monopolist in the region, and then buy it back from them. No, so and of course that is not something that is like a law of nature or physics that requires you to design regulation that way. That's a regulatory choice of the policymaker. And indeed, if they wanted to change incentives for investments, either in energy or in residential real estate or so, these kind of like nitty
Yeah,
gritty, pretty nitty gritty tweaks of the regulatory system have incredibly large effects.
yeah, yeah.
And part of the point of coming to Oxford is to get a sense of how important these are and how they look differently in different countries around across
Yeah,
the globe.
it is. I agree. It's a joy the breadth of participants we have. I think we've had people from 80 countries so far on the program. It's been running for 10 years, and to meet people from 80 different countries. One thing you get to learn is that there are certain things about real estate which are absolutely universal, and some things regulation mainly that are not. But going back to our power problem, we have a PhD student at the moment who I'm working with who is coming across really practical problems and barriers about how we can efficiently use real estate and 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 help this power equation. So she's looking at the fact that if you own some industrial property, your real estate consultant, your valuers, your the investors will capitalize the rent, and they'll know how to do that, and they'll come up with a reasonably accurate opinion of market value. But what they won't know how to price is if you're generating power from the roof, they won't know how to price that. So if I own an industrial estate and I'm generating power from solar panels and I sell that to the occupiers of the building, or I provide electricity to them, the pricing of that power supply will be different from the pricing of the rent.
That's right. Yeah.
Because we have less confidence in the longevity of the income stream, we don't really understand what it's about, and so it's actually discounted so that you end up there with less motivation for the property owner to build the solar panels in the first place. So this is yet another piece of just ignorance driven inefficiency, I think.
Yeah. So, I mean, two things. So one is that the electricity infrastructure, as the word implies, is really more of an, it used to be thought of as a different discipline to think about infrastructure than real estate. And I guess one thing we're observing that these fields are really merging, and that requires a change of teaching, which we're on top of. The other thing I want to say is, of course, there's also a hedging component, right? So if you produce as much electricity as what you're consuming, and you have great levels of uncertainty about future electricity prices, which is important for your business, then you have a natural hedge, an operational hedge effectively by producing the electricity yourself. So there's like a deep corporate finance angle to this as well. Speaking of the corporate finance angle, right? So one thing I love about working with Andrew is Andrew knows a ton about real estate, and in particular, but not limited to the UK. And I come from a more finance background and have lived in lots of other places on planet Earth and transacted real estate in 4 or 5 other countries. So it's a very nice complementarity, you know. So touting my horn in terms of the finance background, Diraj's question regarding the UAE and real estate in Riyadh, he mentions that they've benefited due to a stable currency because dirhams and riyals are directly pegged to the US dollar. I mean, one thing I'll just remind you all of is there's all kinds of currencies that used to be pegged to the US dollar until the day that they weren't, right? So one of them being, for example, the Swiss franc. So one of the things we're gonna or can talk about in the real estate program, both in the executive programs as well as the MBA and the EMB programs, is how you think about exchange rate risks as you finance real estate. I financed US real estate in euros. I financed Swiss real estate in Swiss francs and various other combinations. But one thing you have to be aware of is that these pegs they can change, right? So, what was it? 60% of Hungarian households until 2014 financed their mortgages in Swiss francs because they were cheaper, nominally speaking. But there was a day at Zurich Airport, I do remember buying a double espresso for 6 francs and 50 on the day that the Swiss franc appreciated by what was it, 20% or something relative to the euro. So suddenly these mortgages were worth 20% more than they were the night before. You had a lot of unhappy Eastern European households on that day that suddenly own a whole bunch more, no? So this is a gigantic risk as well that you have to take into account as you think about international currencies, fixed exchange rates versus not.
It's a great point, Martin. We can talk a lot about sustainability and regulation and technology and the way in which these things are constantly changing and it's like being hit by a series of hammer blows in a boxing ring. But actually there are some things which don't change, and the size of the boxing ring doesn't change, and there's always a referee in the middle. So there are some finance principles, aren't there, that are long lasting, and we do try to pull these questions back to some fundamental theory that we believe is well founded, well tested, and probably permanent. There are permanent laws of economics.
Indeed. Indeed, right? So, and that is really the value you get out of an education at a place like Oxford, that it gives you a framework, There's lots of messiness in the world, but there are frameworks that really don't change and that do help you predict the future. Hence, again, the future of a real estate initiative. And once you've seen a few of these cycles and a big part of the cross section of real estate markets around the globe, you do also get a feel for what the constants are, which you should just absorb and rely on confidently, and which are the parts that change either over time or in the cross section to calibrate yourself. So this is what we try to get across in the program.
Great. I think probably it's a good time to hand back to Clara for a bit of a wrap up. But I think we can invite questions from anybody on the call. We've got a bit of time to answer them, but over to you for now, Clara.
Thank you, Andrew, and thank you, Martin. I thought that was a really fascinating discussion going from real estate of the past onto the future. And I think a lot of the topics that you discussed probably touched a lot of the participants who are here on the call. So yeah, thank you so much for giving your time. I'm just going to take a few moments to talk about the real estate program, which you've gone into some depth during the broadcast. So thank you very much for sharing some of these things with us. I'm just going to briefly share my screen with you. So as discussed by the team, we do have the real estate program. It's a wonderful way to talk about some of these issues and really test some of your boundaries and knowledge in different markets with people who are just as passionate about real estate and finding solutions and to some of the problems that Andrew and Martin have discussed. It runs in Oxford in person, so you'll be here in our beautiful campus. I don't know if you have the opportunity to look at Martin and Andrew's backgrounds. Oxford really is that beautiful. So for 5 days here in Oxford, from the 6th of July to the 10th of July, so beautiful summertime, you can join us. And yeah, we mentioned that there's lots of people come to Oxford for the research, for the breadth of knowledge, and also in particular from so many different markets. So you can really think on what they're doing and benchmark it against what your solutions you're coming up with. So just a really brief thing from myself to say, if you're fascinated or curious about this program and you're thinking, I have a couple more questions and I really want to dive into it, I'm always welcome for you to reach out to me. My email address is there. Alternatively, I love a phone call or WhatsApp. That's a great way to reach me. If you are thinking of applying to the program, our applications are open and the applications are coming in. So if this is something you want to jump on, I would say put your application as soon as possible. And we'll review and then we'll have a consultation to see if it's the right fit for you and it's the right time for you to come to Oxford. So I hope you have the opportunity to speak with me. And if not, thank you for joining the webinar. I just want to say, Andrew, Martin, thanks again for the time you spent with us here today. It really was a privilege to have this time with you. What they don't mention is academics are very, very busy and scheduling can be a little bit tricky. So having them both here together to give a very dynamic discussion is really quite special. But if you've really enjoyed speaking with Andrew and hearing from Martin, they will be there in person at the real estate program. So you can debate a little bit more and push on some of these questions they may have had a little bit of more time to digest. But thank you again, everyone, and wishing you a wonderful morning, afternoon, evening, and I hope to see you in Oxford soon. Bye for now.
Thank you very
you.
much.
Bye, Clara. Bye, everybody.